In the world of investing, there are only a few names more significant than Warren Buffett, who is often considered the greatest investor of our time. His company, Berkshire Hathaway, is truly exceptional. Every year, Mr. Buffett shares a letter with his shareholders detailing the performance of Berkshire Hathaway stock since he took charge in 1965. Would you believe that he has averaged a 20.1% yearly return from then until now? This surpasses the market's average of 10.5%. Moreover, Berkshire's total return during this period is an astounding $3.6 million compared to the S&P 500's $30,000. So in this video, we'll thoroughly discuss some of Warren Buffett's ideas, tips, and valuable advice that directly relate to the economic situations we are all set to face in 2024. But before we delve into that, we must understand the seriousness of what lies ahead. We need to consider the economic climate. According to Jim Mastero, Chief Investment Officer at Research Affiliates, who oversees strategies for over $130 billion in mutual funds and ETFs, the U.S. is on the verge of shifting from a decade of abundance to an extended and challenging period of austerity. Moreover, let's not forget the rumors of an upcoming recession that have been circulating for over a year, showing no signs of slowing down or fading away despite the resilient economy and low unemployment rates. A recent Forbes column still predicts a mild recession in late 2023 or 2024. Can you recall what happened in the years that came after the Great Financial Crisis? Did the average American become wealthier? Right? While that's correct, two remarkable things occurred. The initial factor was a period of remarkably low interest rates managed by the Fed. Initially implemented as a measure to protect the economy during the 2008 and 2009 financial crisis, the approach of providing easy money resumed after a brief normalization period. Subsequently, the Fed further reduced rates to counter the impact of Trump's tariffs and significantly intensified these efforts during the pandemic. From the start of 2010 to early 2022, the Fed funds rate stayed above 1% for only 2.5 years, spending the remaining 10 years hovering near zero. The second factor shaping the economic scene is substantial federal spending. Already surpassing inflation from 2012 to 2019, federal spending increased significantly during the COVID outbreak and its aftermath. It rose from $4.45 trillion in fiscal 2019 to $6.82 trillion in 2021, indicating a 53% increase of nearly $2.4 trillion in just 2 years. Although expenditures have slightly decreased, they remain at a plateau significantly higher than pre-pandemic levels. The budget for 2023, at $6.35 trillion, is only 7% lower than the peak recorded 2 years earlier. Over the past decade, these extremely low rates and high government spending brought abundant money into the economy. But now, that's no longer the case. Can you understand why everyone is a bit concerned? Absolutely. You can highlight that the U.S. economy in 2023 taught forecasters a valuable lesson. Despite initial expectations of slow growth, or even a recession due to the challenges posed by inflation, America surpassed many by moving ahead with an annualized growth rate of around 2%, even as inflation eased. But here's the catch. Recessions involve more than just slow economic growth. They often come with other distinct features, such as widespread job losses, a decline in available jobs, and an increase in government relief measures like stimulus payments and enhanced unemployment benefits. These aspects frequently lead investors to consider whether it's smarter to save every dollar in cash or if they should opt for recession-resistant investments. Stock values often decrease, theoretically presenting challenges for existing portfolios. But what if we told you it's actually the best time to generate income? Here's Warren Buffett's take on the bear market.
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news.
For long-term investors looking to build wealth and under the age of about 55, a falling stock market can be advantageous. Being in this age bracket typically means you are still a net buyer of stocks. On the other hand, if you're over 70, you'll likely prefer a consistently high stock market. as you are more of a stock seller at that stage. Regardless of age, most people emotionally react to a declining market. Despite the common practice of feeling more comfortable buying stocks when the market is rising, the optimal time to purchase stocks is during a bear market. Consider it a sales discount, just as you'd seize a 50% discount on something you've always wanted. The same logic applies to stocks in a bear market. Don't hesitate to buy when prices are lower. It's an opportunity to potentially benefit from discounted values. As a long-term investor, you should welcome a falling stock market as an opportunity. Even in a recession, it's wise to take a page from Warren Buffett's playbook and make forward-thinking decisions. In a well-known 2008 op-ed for the New York Times, Buffett advised, "Be fearful when others are greedy, and be greedy when others are fearful." This means that when people are hesitant about investing, especially before or during a recession, you should seize the opportunity to acquire stocks and other assets at discounted prices. Buffett also emphasized that bad news is an investor's best friend, allowing you to buy a piece of America's future at a reduced cost. This advice remains just as pertinent now as it did 15 years ago during the peak of the Great Recession. The only thing to avoid is attempting to predict when the economy and the stock market will bounce back, as even experts like Buffett cannot accurately forecast such outcomes. In fact, he believes predicting stocks is an ill-advised practice.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
Shifting the focus to inflation, Warren Buffett advises strategic investing. Key concepts emerge here. First, during high inflation periods, enhancing earning power is crucial. Increasing your value to employers allows your income to rise in sync with inflation. Additionally, Buffett recommends a passive strategy against inflation by identifying a high-quality business and maintaining long-term investment. In his 1981 shareholder letter, he outlined businesses effective against inflation with two key traits. They should easily raise prices even in stagnant demand without losing market share, and accommodate increased dollar volume with minimal capital investment. In essence, scalable businesses fare better during inflation. For instance, a tech firm like Instagram can add ads with minimal cost, unlike an auto manufacturer like General Motors or Toyota, requiring substantial investment and time to scale up production by 50%. Returning to the key point of navigating inflation through investing, Warren Buffett's highlighted characteristic is crucial. Inflation-resistant companies can raise prices without losing market share or unit volume, showcasing a competitive edge and pricing power. Buffett praises Apple for this quality, evident in his enthusiastic endorsements.
Against inflation is to improve your own earning power, your own talents. Very few people maximize their talents. And the best investment, passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens.
Apple's intrinsic value lies in its immersive ecosystem, creating strong customer loyalty. iPhones deemed luxury items foster a cycle of upgrading for social appeal. The importance of moats, like patents or strong brands, in inflation cannot be overstated. Businesses with such advantages, such as Coca-Cola, Apple, and MasterCard, possess pricing power to counter inflationary pressures. MasterCard's extensive network and transaction earnings make it an inflation-resistant investment. Its vast scale, processing trillions in transactions, contributed to a $10.1 billion free cash flow in 2022. This, coupled with the ongoing shift from cash to cards, positions MasterCard as a future-proof investment in overcoming inflation. Now, let's address the issue of soaring interest rates. With rates at such elevated levels, how can we navigate the economic landscape of 2024? Here's an intriguing perspective from Warren Buffett.
Interest rates, basically are to the value of assets what gravity is to matter, essentially.
Honestly, this is the best way to understand interest rates. In times of low rates, money is readily available, fostering spending, profits, and growth, as seen in the past decade. However, with rates rising, borrowing becomes costlier, challenging businesses to repay debts and reducing consumer spending. This tough environment impacts businesses, reflected in financial results and stock prices. Examining the last 5 years reveals a clear link between interest rates and stock market performance. Notably, in 2018, rising rates corresponded to a stagnant stock market. Conversely, 2019's market rise coincided with declining rates. The pandemic prompted a zero interest rate response, resulting in a thriving market for 2 years. Yet, 2022 saw a 20% stock market drop with a significant rate increase. This pattern suggests that rising interest rates often lead to stock declines, influenced by business performance and the impact on risk-free government bonds. Maintaining a long-term perspective allows investors to capitalize on lower stock prices for lasting returns. Considering our limited control over the Federal Reserve's actions, our approach should focus on the long term, investing in excellent businesses at attractive prices during elevated interest rates. Even with Warren Buffett's guidance on navigating 2024's investing challenges, financial success requires checking 3 boxes. First, maintain ample emergency savings, covering 3 to 6 months of living expenses. Secondly, avoid touching your portfolio for at least 7 years. Lastly, resist the urge to obsessively check your portfolio during economic challenges, as frequent monitoring can lead to panic and hasty decisions, harming your overall